Imagine for a second that you were building the exact infrastructure that every major tech company desperately needs for this. Well, this massive $700 billion gold rush.
Right, a literal gold rush for AI.
Exactly. And you're holding a war chest of like $2.1 billion in cash. You report a quarterly revenue spike of 139%.
Which is just a huge jump.
It is. But then the market looks at your latest earnings report and decides to punish your stock with a 5.5% drop.
Yeah, that's the real paradox here.
Welcome to the deep dive. Today, we are focusing on Applied Digital ticker APLD and their Q3 2026 earnings report from April 8th, 2026.
That's a super interesting report, by the way.
Oh, absolutely. And our mission for you today is to look right past that top-line stock ticker noise. We want to examine the gritty physical realities, the massive power constraints, and the incredibly complex financial engineering going on behind the booming AI infrastructure market.
Because, the market reacted to a top-line gap earnings miss. But if you actually look at the underlying financial mechanics in this report, you see something else entirely.
Right.
You see a management team attempting to build a pure-play infrastructure giant in real time. I mean, they are navigating capital bottlenecks and physical constraints that are entirely unique to this current technology cycle.
Okay, so let's unpack this, because before we can evaluate the balance sheet, we really have to establish the physical footprint.
Yeah, the actual nuts and bolts.
Exactly. The term cloud makes data storage sound, weightless. But the reality for Applied Digital looks like 1,200 skilled craft professionals braving North Dakota winters to physically finish the Polaris Forge 1 campus.
Which is no small feat in that kind of weather.
No, not at all. And that physical construction is what drove their revenue up 139% to $126.6 million this quarter.
We really have to ground the financials in what is actually being built here. I mean, Applied Digital now has their first 100-megawatt direct-to-chip liquid-cooled data center fully online.
And it's functioning right now at Polaris Forge 1.
Yes, exactly. And building a liquid-cooled site is fundamentally different from, legacy data centers. You can't just upgrade the air conditioning for the latest generation of AI processor.
Yeah, so they run so hot, right?
Right. The thermal density requires piping liquid directly to the server racks.
Yeah.
So having a 100-megawatt facility of this specific type functioning today puts them in a very narrow elite category of infrastructure providers.
And they are actively building 2 more 150-megawatt facilities at that same Polaris Forge 1 campus. On top of that, they've laid the foundations for a 200-megawatt hyperscaler campus called Polaris Forge 2.
Yeah, the scale is just massive.
It's huge. And they also just broke ground on a 300-megawatt site in the southern U.S. called Delta Forge 1, which is slated for mid-2027.
And that aggressive timeline, well, it's a direct response to the broader market data they cite in their report. I mean, U.S. hyperscaler annual capital expenditures have surged from $400 billion to nearly $700 billion.
Wow.
Yeah. Applied Digital recognized this impending bottleneck 2 years ago. That's why they are pouring concrete today, while competitors are still, trying to secure zoning permits.
Which is a huge structural advantage. But let me challenge that narrative for a second, if I can.
Sure. Go ahead.
You're talking about this massive land grab and unlimited demand, but the report explicitly mentions they completely paused the development of a site in South Dakota.
It did, yeah.
So in an infrastructure boom where everyone is racing for capacity, halting construction usually suggests, that a company is burning through cash too quickly and has to pull the plug. Are we sure this is strategic discipline and not like a severe red flag?
I get why it looks that way, but the data actually points to capital discipline rather than a cash crunch.
Okay, how so?
Well, the company was negotiating for specific legislative tax exemptions in South Dakota. And when the state legislature adjourned without granting those exemptions, the internal rate of return on that specific site dropped below their target threshold.
So the math just didn't work anymore.
Exactly. Instead of pushing forward just to claim the megawatt capacity, they halted the project. They reallocated the capital and the equipment to 4 other sites in their pipeline, including that Delta Forge 1 site.
Because the tax environment and the unit economics there yield a higher return on invested capital?
Spot on. It's just smart capital allocation.
Okay, so if the physical build is humming along and they have the cash to reallocate resources effectively, we arrive at the core paradox of this earnings report.
A big elephant in the room.
Right. Why did they post a $100.9 million GAAP net loss this quarter? I mean, that translates to a 36-cent loss per share, which is what triggered the market sell-off.
Yeah.
So what does this all actually mean for the health of the company?
Well, what's fascinating here is that to understand the operating health of the business, you have to look past the top-line GAAP figure and look at their adjusted EBITDA.
Which was actually positive, right?
Yes, it was a positive $44.1 million. That massive $100.9 million GAAP loss was primarily driven by a single $59.7 million non-cash impairment charge.
Okay, wait. A non-cash impairment charge means they didn't actually, like, write a check or lose $60 million in cash in their bank accounts. It's just an accounting adjustment.
Exactly, it's paper.
But what triggers a penalty that massive in a single quarter?
It really comes down to how accounting rules handle assets that change their strategic purpose. So previously, Applied Digital categorized their cloud services business as held for sale on the balance sheet.
And when an asset is held for sale, you stop depreciating it.
Right. But management found a more strategic path than an outright sale. They decided on a spin-off. And because they changed their mind and pulled the asset out of the held for sale category to execute the spin-off, well, accounting standards require them to reclassify it as an operating asset.
Oh, I see.
Yeah, and that forces a massive catch-up on depreciation and a reassessment of its carrying value. Boom, you get a sudden $60 million paper hit.
Okay, let's look at the mechanics of the spinoff because it's super interesting. They are separating this cloud business by combining it with eKso, Bionic ticker eKso, to form a new publicly traded company called Chronoscale Corporation, ticker CHRN.
And Applied Digital will still own about 97% of it.
Right. So to give you, the listener, a relatable analogy here, it's kind of like a wildly successful restaurant realizing they shouldn't try to farm their own vegetables and run the dining room at the same time.
That's a great way to put it.
Yeah, they're spinning off the GPU rental cloud business, so Chronoscale can go out and raise its own capital. Meanwhile, Applied Digital focuses entirely on being the ultimate landlord for the physical data centers.
And that capital segregation is perfectly timed. The farming, in your analogy, purchasing and renting out GPUs, is incredibly capital intensive. GPUs depreciate rapidly and require constant, massive cash injections to stay competitive.
Well, whereas the data center is a steady, predictable real estate asset.
Exactly. By spinning the GPU business into Chronoscale, Applied Digital walls off its own balance sheet from that brutal hardware depreciation cycle.
Which leaves them free to just build the physical rooms, the liquid cooling systems, and focus on the power infrastructure.
And speaking of being the ultimate landlord, the biggest problem for any data center landlord right now isn't finding tenants.
No!
No, it's finding electricity.
The power bottleneck. This is where it gets really interesting.
Oh, it's severe. Management actually highlighted a quote from Elon Musk during the earnings call to frame this.
Oh, wow. What did he say?
Musk stated that even if the industry were to utilize all of the available excess power currently sitting on the grid, it still would not be sufficient to meet the projected demand for new data centers.
Wait, really? The whole grid?
The whole grid. The terrestrial power grid is so thoroughly tapped out that industry leaders are having serious strategic discussions about building data centers in space.
That's insane. Data centers in space.
Utilizing low Earth orbit solar power? Yeah. So when the industry is looking at space, because the local utility company can't provide enough juice, the value of terrestrial sites with guaranteed power just skyrockets.
Which brings us to a completely separate entity mentioned in the report, Base Electron. This is an independent power producer, or IPP, teaming up with Babcock & Wilcox to build a 1.2 gigawatt natural gas power plant right into the Dakota's grid.
And the relationship between Applied Digital and Base Electron is just a masterclass in structural risk management.
Let's break that down, because a logical question for the listener might be, if power is the ultimate constraint, why doesn't Applied Digital just buy Base Electron and own the power plant directly?
Right, vertical integration seems like the obvious play.
Yeah, if you need the power, own the power. Why invite a middleman?
Because the risk profiles are just fundamentally incompatible. A hyperscale data center lease is essentially a 15 to 30-year bond.
So the tenant guarantees monthly lease payments even if they never turn on a single server.
Exactly. Highly predictable cash flow. But power generation, that carries severe operational, regulatory, and commodity risks. I mean, natural gas prices fluctuate wildly.
And turbines require heavy maintenance. So if you fold a volatile commodity business into a predictable real estate business, you completely change the risk profile of the stock.
And you likely scare off your core infrastructure investors. So instead of owning the plant, Applied Digital is supporting Base Electron with a limited guarantee.
How does that work?
Well, an independent power producer needs bank loans to start permitting and construction. But banks hesitate to lend to a new IPP without a backstop. So Applied Digital uses its strong balance sheet to guarantee those initial loans.
Ah, I see.
But the crucial detail is that this guarantee automatically terminates the moment Base Electron either raises $50 million in equity or goes public.
So Applied Digital takes on a very short-term, highly defined development risk just to help the power company get off the ground.
Exactly. And in exchange, they receive 10% equity in Base Electron. But most importantly, they ensure that 1.2 gigawatts of power actually gets built and connected to the local grid right where their data centers operate.
And the moment the power company is stable, the liability drops off Applied Digital's balance sheet entirely. They get the grid power for their sites without taking on the downside risk of running a utility company.
Mitigating risk is crucial, especially when you consider how they are financing all of this.
Right, because securing the power grid is one thing, but building these campuses requires a jaw-dropping amount of capital. We noted earlier they have $2.1 billion in cash, but the balance sheet also shows $2.7 billion in debt.
It's a massive undertaking.
A campus like Polaris Forge 2 is a $3 billion project. So how do they afford to build these massive campuses without diluting their shareholders to zero?
They're relying on two very distinct financial mechanisms. The first is actually a legacy segment of their business that provides vital, immediate liquidity.
You mean the data center hosting segment, right? The crypto and Bitcoin mining side.
Yes, it's quietly funding operations. It's their highest return on assets, generating $13.9 million in operating profit this quarter on just $119.6 million in reported assets.
That return on assets is really exceptional compared to the rest of the business.
It is. Because crypto hosting doesn't require the massive capital expenditure of AI liquid cooling. You're just providing standard racks, power, and industrial fans. So this segment serves as a steady cash cow that funds the daily operating expenses.
But operating expenses are very different from capital expenses. I mean, generating $14 million a quarter is great for keeping the lights on at headquarters, but it doesn't buy you a gigawatt of direct-to-chip liquid cooling infrastructure.
No, it doesn't. Which brings us to the second, far more critical mechanism. If we connect this to the bigger picture, the real future is in lowering the cost of institutional capital.
Tell me more about that.
The report detailed a major structural breakthrough with their CoreWeave lease at Polaris Forge 1. They successfully transitioned this lease into a special purpose vehicle, or an SPV.
Okay, let's break down the mechanics of an SPV for the listener. An SPV is essentially a legally separate subsidiary like a financial box. Applied Digital takes the CoreWeave lease and places it inside this box.
Right.
But why does putting the paperwork into a separate legal box change the cost of borrowing money?
Because it completely changes the counterparty risk for the lender. Previously, the entity holding the lease had a BB credit rating non-investment grade.
And banks charge a high interest rate for BB assets to offset default risk.
Exactly. But by placing the lease into an SPV, they ring-fence it from the rest of Applied Digital's corporate risks. Furthermore, CoreWeave backed this specific SPV with a $50 million letter of credit and an unconditional parent guarantee.
So they isolated the cash flow and heavily fortified it.
Yes, and when the rating agencies evaluated that specific ring-fenced box, they upgraded its credit rating to A3, which is solid investment grade.
Oh, wow, that's a huge jump.
It is. Management explicitly laid out the financial spread. Moving a tenant from BB to single A means borrowing costs can drop from a 350 to 450 basis point spread down to the mid-200s.
We're talking about shaving roughly 1.5 to 2 full percentage points off their borrowing costs.
Which is massive at this scale.
Right. Apply that to a $1 billion construction loan over a 15-year lease, and you're saving tens of millions of dollars in interest. Management explicitly noted this shift from high-interest project loans to lower-rate market debt is the key tipping point.
It's the mechanism where shareholder value will truly unlock. And it completely supports their long-term goal of hitting $1 billion in net operating income within 5 years.
$1 billion in net operating income, that seems so detached from the $100 million gap loss they reported today.
I know it sounds crazy until you look at the architecture.
Yeah, when you follow the threads. They use the crypto business to fund daily OPEX. They use limited guarantees to secure grid power without utility risk. They spin off the GPU cloud business, and they use SPVs to secure investment-grade debt.
It is a deliberate, methodical assembly.
Applied Digital is basically playing a massive, multi-billion-dollar game of Monopoly. They are securing the real estate, guaranteeing the grid power, building the physical infrastructure, and locking in 15 to 30-year leases with investment-grade tenants.
They are putting hotels on boardwalk, and they know the hyperscalers have absolutely no choice but to land there and pay the rent.
It's a fascinating strategy.
It really is. And I want to leave you, the listener, with a final thought to ponder long after this deep dive concludes.
What's that?
We spend so much of our time marveling at the software of artificial intelligence, right? The chatbots, the image generators, the algorithms.
Sure, it's what's visible.
Exactly. But based on this $700 billion CapEx arms race we've examined today, is it possible that the true winners of the AI revolution won't be the companies writing the code?
Oh, I see where you're going.
Yeah. What if the enduring economic victors are actually the landlords who control the concrete, the liquid cooling, and the actual electrons powering the grid?
You simply cannot run a massive language model if you don't have the physical infrastructure to plug it in. Perhaps it is time we spend less energy looking at the software and start paying much closer attention to the concrete.
I couldn't agree more.
Thank you for joining us on this deep dive into the physical reality of the AI infrastructure market. Keep questioning the world around you, look past the surface, and we'll catch you next time.